Top three things in my notebook this morning in the world is number one, the Japanese yen, number two, all of Europe, and number three, the Russell 2000. So first on the Japanese yen, you have to follow the bouncing ball here. GDP obviously surprises to the downside yesterday. Economic reality bites. Nikkei goes down, and then they come up with the next central plan this morning. And people who look at the chart of the Nikkei, much like looking at the chart of the Weimar Republic stock market in 1924, says, I want more of that. So again, the Japanese are looking for a snap election on December the 14th. My question to you, if you're along the Nikkei, what happens if he loses the election? Net, you look at this within the prism that is the risk range of the Japanese yen. The downside risk to the range now is 114.04, with immediate term oversold for the Japanese yen. Again, looking at it versus the dollar at 116.97. So it's a very interesting spot, if only because the Japanese yen have been completely burnt to a crisp. All correlation risks in markets have gone berserk on that. And if you tap the top end or the low end, however you look at it upside down on the end of the range, what happens next, Mr. Abe? That'll be a question that the market will have to answer tomorrow morning. Looking at Europe across the board, again, you get one of these many bounces we've had. We've had short selling opportunities in European equities, for 3 months? And again, the central plan is not working. What you're getting more of is deflation. So again, on the bounces, our two preferred short selling opportunities are in France and Italy. So EWI and EWQ are the ETFs on that. No, we don't have positions on in real-time alerts currently, but we are looking forward to putting those shorts back on, indeed, this morning. Now, again, looking at the Russell 2000, something not so funny happened on the way to the storytelling forum. Everyone's navel-gazing at the Dow. The S&P doesn't go down. But guess what? The Russell 2000 is down almost 2% in the last 3 trading days. Now, for those of you who've been following this closely, you know that we do not like the Russell 2000. It's flat for the year to date, which stands in stark contrast to something like TLT, which is a long bond, which is up about 18% for the year. Now, again, breaking down in the face of the S&P not going down is called a negative divergence. So again, if you're looking at downside support right now for the Russell, there is none to really 1148, and actually all the way down, if that breaks, to 1005, which is again where we saw in October, and very few were positioned for that. So those are your top 3 things.